Are you constantly stressed about money? Do you feel overwhelmed by the sheer volume of conflicting financial advice out there, often making you feel paralyzed and unsure where to even begin? You're not alone. The world of personal finance can seem like a chaotic maze, filled with jargon and complex choices that leave many of us feeling like Sam. Sam received an inheritance, and though he knew he should invest it, the flood of contradictory advice from friends, family, and wealth officers at the bank left him scared and stuck, doing absolutely nothing. As a result, his money lost value to inflation, and he missed out on market gains because he was too overwhelmed to act. Studies show that almost 3 out of 4 of us experience financial stress monthly, and many fear outliving our retirement savings. It's not entirely our fault. Economic trends, stagnant wages, and constant marketing of luxury make saving incredibly difficult, and financial pressures can lead to poor decisions, a phenomenon known as tunneling. But what if the most important financial advice was so simple it could fit on an index card? Welcome to The Index Card. Written by Helaine Olen and Harold Pollack. Helaine Olen, author of Pound Foolish and a financial columnist, has extensively covered the pitfalls and traps of the financial services industry. Harold Pollack, a University of Chicago professor, developed the core concept of the index card, not as an academic exercise, but as a practical solution to his own urgent financial problems. This book builds on Harold's original index card, which unexpectedly went viral after he offhandedly mentioned that correct financial advice should fit on a 3x5-INCH card and be available for free. Together they offer a clear, concise guide to personal finance, cutting through the noise and empowering you to take control. Let's dive into the core rules that can transform your financial life. Rule number 1. Strive to save 10 to 20% of your income. Harold Pollack once found himself in a financial freefall. After years of treading water financially, making poor investment choices in dot-com stocks, and accumulating costly debts, life delivered a series of unexpected blows. His wife Veronica suddenly lost her mother, leading to the unexpected responsibility of caring for her brother, Vincent, who has a disability. This meant Veronica had to leave her job, their income fell, and expenses soared due to Vincent's medical needs and costly equipment. Then, Veronica herself faced a serious heart infection. Harold realized he needed real answers to right our financial life. This led him to piece together a new financial regimen, finding that the most important advice was embarrassingly simple, including saving consistently. The book emphasizes that saving is the bedrock of your financial life, much like a sturdy foundation is essential for any house, no matter how grand. Without learning to save, you can't effectively invest or pay down debt. Many struggle to save, and it's not entirely their fault. Wages have stagnated. The cost of essentials like healthcare, housing, and education has risen faster than incomes, and society constantly markets luxury, creating a trickle-down consumption effect where people feel pressured to keep up. This can lead to what economists call tunneling, where constant financial stress impairs your ability to make good long-term decisions, often leading to reliance on credit. To start, you need to know where your money goes. The book suggests a practical, flexible approach rather than a rigid budget. Monitor your spending. For 3 months, track every penny you spend, no matter how small. Tools like Mint.com or Quicken.com can automate this, allowing you to categorize expenses and see the big picture. Confront and refine. At the end of the first month, review your non-negotiable expenses. Over 3 months, you'll gain a full picture of sporadic costs, like car repairs or pet care. Create a flexible plan. This isn't about deprivation. Your plan should account for what you earn, what you need to spend, and allow room for trade-offs and fun. Remember the non-latte factor. Focusing on cutting small expenses like a newspaper subscription won't fix big problems like rising health insurance premiums. Tackle larger outlays like housing and transportation in the long run. Embrace cash. Studies show people spend 20% more using plastic than cash, because paper money feels real. Using cash can help you feel the pain of parting with money, encouraging more mindful spending. Automate savings. The easiest way to save is to make it automatic. Use direct deposit to send a portion of your paycheck directly to a separate savings account. For freelancers, deposit all income to savings and then pay yourself a monthly salary. 1. Consider naming your sub-accounts, e.g., vacation, emergency fund, to make savings goals feel more tangible. Emergency fund first, but balance with debt. Your first priority should be building an emergency fund of 3 months of non-negotiated living expenses, mortgage, groceries, etc. This provides stability for unexpected events like job loss or medical emergencies. However, don't prioritize this over high-interest credit card debt, as the cost of interest will outstrip any savings gains. Start small. If saving 10 to 20% seems impossible, don't despair. Start by saving just 1% of your take-home pay, then increase it by 1% each month. This builds your savings muscle over time, making it stronger. Key takeaways for rule number 1. Saving is the essential foundation of your financial security. Monitor your spending meticulously for 3 months to understand your habits and identify areas for adjustment. Build an emergency fund of 3 to 6 months of necessary living expenses to cover unexpected events. Make your savings automatic through direct deposit or dedicated transfers to a separate account. Prioritize paying off high-interest credit card debt, even over fully funding your emergency savings, due to the high cost of interest. Start small with saving, e.g., 1% of income, and gradually increase as your savings muscle strengthens. Focus on controlling large, non-discretionary expenses rather than just small daily purchases. Rule number 2. Pay your credit card balance in full every month, and how to deal with other forms of debt. For years, Harold and Veronica struggled with credit card debt, even with a steady, middle-class income. They used their high-interest plastic as their go-to rainy day fund, leading to tense times and quarrels about money. This isn't unique. Average credit card debt per US household exceeds $7,000, and over half of us don't pay our bills in full every month. We beat ourselves up, thinking our grandparents had some secret discipline, but the truth is simpler. They simply lacked easy access to credit. Back then, stores offered layaway, and getting loans was far more difficult. Today, it's a different story. Credit has loosened significantly, and credit card companies actually profit most from those who don't pay off their balances in full. If you use your card and pay it off, they call you a deadbeat because they don't make money from you. But if you carry a balance, you become a profit center due to high interest rates. There is no better way to simplify and gain control over your financial life than by eliminating high-interest debt. Think of it this way. The average credit card interest rate is around 15%, often 25% for store cards. Paying off this debt gives you a tax-free, risk-free return equivalent to that interest rate, an investment opportunity unmatched by anything else. Be a deadbeat. Pay off your credit card balance in full every month. Pay more than the minimum. The minimum payment displayed on your statement is a trap, leading many to pay only that amount due to anchoring. This keeps you in debt for years and significantly increases your total cost. Rank your debt. If you can't pay everything off immediately, list all your debts: credit cards, student loans, and their interest rates. The financially smartest approach is to pay down the bill with the highest interest rate first, while making minimum payments on others. This is often called the debt avalanche method. Some prefer the momentum method, paying smallest debts first for a psychological boost, but it will cost you more in interest. Don't go it alone. Find an accountability pal, a friend or relative you check in with to stay on track. Support groups, online and in person, can provide motivation and shared strategies. Negotiate your bills. Call your creditors and ask for lower interest rates. The worst they can say is no, but they may agree to avoid you transferring your balance or seeking bankruptcy. Be cautious with balance transfers, as new debt might be charged at higher rates, or there might be hidden fees. Reduce credit card spending. Avoid running up new debt while paying down old debt. Use cash, debit cards, or prepaid cards. Don't fall for credit card rewards programs. They often lead to increased spending and debt, costing you more than the rewards are worth. Instead, reduce spending and buy yourself a prize. Debt consolidators and bankruptcy. Proceed with extreme caution with debt consolidators or settlement companies. They often charge high fees, might not contact creditors, and consolidation loans are typically secured by assets like your home or car, putting them at risk. If you are desperate, it might be better to speak with a bankruptcy attorney. There is no shame in declaring bankruptcy. It allows you to wipe out or restructure debts, especially if caused by unforeseen events like healthcare bills or unemployment, and protects retirement accounts. Student loans. These are unique. Always borrow from the federal government first, as they offer more flexibility, income-based plans, deferment options than private lenders. Even if a federal loan has a higher interest rate than other debts, it's often advisable to pay off almost every other bill before tackling federal student loans. Be careful with student loan consolidation, especially combining federal and private loans, as you can lose federal benefits. Avoid private counselors offering to reduce student debt, as they are usually high-priced and predatory. If you can't keep up, don't default. Seek help from the Department of Education or Consumer Financial Protection Bureau. Key takeaways for rule number 2. Eliminating high-interest debt is your best investment, offering unmatched tax-free, risk-free returns. Always pay more than the minimum on credit cards to avoid prolonged debt and excessive interest. Rank your debts by interest rate and prioritize paying the highest rate debt first. Debt avalanche method. Consider an accountability partner to help you stay on track with debt repayment. Be extremely wary of debt consolidation companies and free financial advice. They often have conflicts of interest and high fees. Do not be ashamed to declare bankruptcy if it's the right solution for your financial situation, especially when triggered by life events. For student loans, prioritize federal loans over private, and be cautious with consolidation and private assistance. Rule number 3. Max out your 401k and other tax-advantaged savings accounts. Harold wishes he had started saving earlier. On his very first day at his first job, he ignored the paperwork for retirement savings. He got a late start professionally and missed out on one of the biggest stock market run-ups in history. Only by starting to save 20% of his pre-tax income at age 40 was he able to begin catching up. This highlights a crucial point. When it comes to planning for retirement, playground rules apply. No do-overs. The conventional wisdom that you'll work forever is often a myth. Most retirees leave the workforce earlier than planned due to health issues, caregiving needs, or age discrimination. Don't assume your skills will always be in demand, or your body will always cooperate. Start young. Due to compound interest, the earlier you start saving, the more powerful compound interest becomes. For example, saving just $104 a month from age 25 could yield $200,000 by age 65. To get the same amount starting at 45, you would need to save 4 times as much, about $430 a month, precisely when other expenses like college tuition might be higher. Utilize tax advantage accounts. Don't just use a regular brokerage account. Workplace retirement plans like 401ks and individual retirement accounts, IRAs, offer significant tax benefits that boost your long-term gains. Money grows tax-free, and withdrawals are often taxed at a lower rate in retirement. Never forgo the employer match. If your employer offers a matching contribution to your 401k or 403b, contribute at least enough to get the full match. This is free money. Turning it down is like turning down a larger salary. 1 in 4 workers misses out on an average of $1,336 annually by not taking full advantage of this benefit. Understand IRAs, traditional, Roth, SEP IRA. Traditional IRA offers an immediate tax deduction, and money grows tax-free, but withdrawals are taxed in retirement. Roth IRA. Contributions are after tax, but qualified withdrawals in retirement are entirely tax-free. SEP IRA. For freelancers or business owners, allowing contributions of up to 25% of self-employment income to a high limit. MyRA. A new option for employees without workplace plans, offering guaranteed, low-expense government funds to help start saving. Make IRA deposits automatic to avoid hassle and temptation. Avoid early withdrawals from retirement accounts. About 1/3 of people borrow from their 401ks before retirement, often for emergencies or college expenses. This leakage severely undermines long-term savings. While tempting, early withdrawals often incur a 10% penalty plus taxes. It's best to leave this money alone unless it's a true, dire emergency with no other options, as retirement accounts are often protected from creditors in bankruptcy. Don't automatically roll over old 401ks. When changing jobs, resist the urge to roll your old workplace retirement plan into a new IRA just because TV ads or mutual fund companies suggest it. Workplace plans often have lower fees and stronger regulatory protections than individual rollover IRAs, which can come with high expenses that erode your savings. College savings accounts. After maxing out your retirement contributions, consider Coverdell Education Savings Accounts, ESAs, or 529 plans for college savings. These allow money to grow tax-free for qualified education expenses. Key takeaways for rule number 3. Start saving for retirement as early as possible to maximize the powerful effect of compound interest. Always contribute enough to your 401 kuna or 403 beats per minute to get the full employer match. It's essentially free money for your future. Utilize other tax advantage accounts like traditional IRAs, Roth IRAs, or SEP IRAs to supercharge your savings growth. Avoid taking money out of retirement accounts early due to penalties and significant loss of long-term growth potential, unless truly out of options. When changing jobs, don't automatically roll over your old 401k into a separate IRA if your new employer's plan or the old plan offers better, lower fee options. Consider college savings accounts, like 529 plans or Coverdell EAs after you've maxed out your retirement contributions. Rule number 4. Never buy or sell individual stocks. Harold learned his lesson about individual stocks growing up in Rochester, New York, the home of Eastman Kodak. Kodak was once an iconic, seemingly sure bet company, controlling almost the entire film market and even part of the Dow Jones Industrial Average. Many families in Rochester had their savings tied up in Kodak stock. But then, Fujifilm and digital technology struck, and Kodak declared bankruptcy in 2012. Wiping out investments. Harold's family friend Miriam invested in a local pizzeria that went public, convinced it was a sure winner. For a while it was exciting, but the stock eventually became almost worthless. Helaine admits she's a Miriam too, having invested in AOL instead of Amazon during the dot-com boom, despite knowing better. The truth is, you are not Warren Buffett. While he's a legendary stock picker, he benefits from access to deals unavailable to average investors. In fact, even Warren Buffett advises his own heirs to invest in a pitfall, very low-cost S&P 500 index fund, not individual stocks. Behavioral finance research repeatedly shows that individual investors are prone to making the wrong calls, buying high and selling low, panicking, and ultimately underperforming the market. Less than 1% of individual investors consistently beat the market. Financial advisors and media don't help. Brokerage houses and financial TV shows like Jim Cramer's Mad Money have an incentive to encourage you to trade, as they make money from commissions, regardless of whether you win or lose. They preach that playing the stocks is easy and fun, but this is a toxic message. Academic analyses have even found that betting against Jim Cramer's stock picks often yielded better returns. No one on TV, the internet, or at expensive conferences has a crystal ball for the market's future. Beware alternative investments. These are often marketed as exciting new opportunities, like Bitcoin or collectibles, but are essentially really risky investments that are hard to transparently value and that are subject to great swings in price. Don't treat hobbies like collecting stamps or Beanie Babies as investments. They're unlikely to pay off financially. The buy and hold secret. Trying to time the market or pick winners based on trends is speculation, not prudent investing. You cannot foresee every consumer win, executive shakeup, or unexpected event that affects a company. The solution is simple. Buy and hold a small selection of indexed mutual or exchange-traded funds for the long haul. Focus on what matters. Realizing that stock picking is a loser's game for most should be a huge relief. You don't need to obsessively monitor business news or annual reports. Your time is valuable, and your happiness and security depend more on your marriage, family, work success, and relationships. Investments in those areas are almost certain to pay off. Key takeaways for rule number 4. Never buy or sell individual stocks. They are highly risky and consistently underperform for most individual investors. Recognize that financial media and advisors often have incentives to encourage trading because they profit from commissions, not necessarily your success. You are not a financial wizard. Even legendary investors like Warren Buffett recommend simple index funds for their heirs. Avoid alternative investments like gold or collectibles, as they are often highly speculative and volatile. Embrace the buy and hold strategy with diversified funds, freeing up your valuable time for what truly matters in life: your family, work, and relationships. Rule number 5. Buy inexpensive, well-diversified indexed mutual funds and exchange-traded funds. Once you've stopped chasing individual stocks, the next step is to understand where to put your savings. The common answer, mutual funds, isn't as straightforward as it seems. Most mutual funds are actively managed, meaning a professional manager tries to pick winning stocks and bonds to beat the market. The industry wants you to believe these highly paid experts have unique insights, like T. Rowe Price claiming to understand the connections of a complex global economy. However, the data tells a different story. Over a 5-year period, more than 80% of domestic stock funds performed worse than the market index they aim to surpass. Why? Because, as the book explains, even highly educated, credentialed managers are susceptible to the same pitfalls and biases as individual investors. Research consistently shows that less than 1% of actively managed funds beat their benchmark once trading and other expenses are factored in. Follow Warren Buffett's advice. Invest in index funds. The true magic investing formula is found in index funds. These funds are designed to match a specific market benchmark, like the S&P 500, rather than trying to beat it. This passive management is what Warren Buffett recommends for his own heirs. Beware of fees. Index funds consistently outperform actively managed funds because they have significantly lower fees. Actively managed funds charge for research, trading, and advertising, much like a contractor padding a bill. While the average annual fee for a managed fund is 0.89%, an equity index fund averages a much more reasonable 0.12%. This seemingly small difference adds up to thousands of dollars in lost gains over time. For example, a $5,000 investment over 30 years could yield over $5,000 more in a low-fee index fund compared to a high-fee managed fund. These fees are not worth it, as they don't produce greater or more reliable returns. Not all index funds are equal. Even among index funds, fees vary. Some charge significantly more than others, e.g., 0.7% versus Vanguard's 0.17%. Always seek the lowest expense ratio possible, as this difference directly impacts your returns. Mutual funds versus exchange-traded funds. ETFs can be traded like stocks throughout the day and often have lower expense ratios, while mutual funds are bought or sold at day's end. For long-term investing, the ability to trade daily isn't important. What matters is diversification and low fees. Simple diversification, asset allocation. Don't be intimidated by terms like asset allocation. It simply means spreading your risk by investing in different types of assets, like stocks and bonds, so your entire portfolio doesn't rise and fall together. You don't need dozens of complex funds. Stocks versus bonds. Stocks, shares in companies, tend to offer higher long-term returns, but come with more volatility. Bonds, loans to companies or governments, are generally more stable but offer lower returns. Age-based allocation. A common guideline is to subtract your age from 100, or 110, to determine the percentage of your portfolio to invest in stocks, with the rest in bonds. For example, a 40-year-old might have 60% in stocks and 40% in bonds. Adjust for your risk tolerance and when you'll need the money. Suggested stock allocation for a diversified portfolio. 70% in a good S&P 500 index fund. This provides broad exposure to large U.S. companies, including those with significant international sales. 15% in a small-cap index fund. These offer exposure to smaller, more agile companies with potential for higher growth, though with greater risk. 15% in a broad-based international fund. This ensures diversification beyond U.S. markets, including developed and emerging economies. Simplified option. If this feels too complex, you can replace the S&P 500 and small caps funds with a single total stock market index fund, representing the entire domestic market. For bonds, a long-term bond index fund is sufficient. Real estate, optional. If you don't own a home, consider a small percentage, 5 to 10%, in a real estate investment trust index fund, REIT. To gain exposure to commercial properties, avoid target date funds. While alluring for their simplicity, many target date funds have surprisingly high fees and often give investors a false sense of a blanket guarantee, which is simply untrue. Keep it simple. The strategies recommended are based on solid research, designed for long-term investment, and require minimal time or expertise. Check your investments once a year, allowing you to focus on the parts of your life that matter most. Key takeaways for rule number 5. Avoid actively managed mutual funds as most consistently underperform market indexes due to high fees and human biases. Investment: low-cost, passively managed index funds that simply track a market benchmark, like the S&P 500. Prioritize funds with the lowest expense ratios, as fees significantly erode your long-term returns. Diversify your portfolio with a simple mix of stock and bond index funds, typically allocated based on your age. For stocks, consider a combination of S&P 500, small cap, and international index funds, or a single total stock market fund. Be cautious of target date funds, which often carry high fees and misleading expectations. Keep your investing strategy simple and review it annually, freeing up time for your life. Rule number 6. Make your financial advisor commit to the fiduciary standard. Harold's friend Karen boasted she didn't pay fees to her financial advisor, believing the funds he invested in covered everything. In reality, her investments carried high fees, and her broker likely earned commissions every time he moved her money. This common misconception is widespread. Most people believe that anyone calling themselves a financial advisor or affiliated with their workplace retirement plan is legally bound to act in their best interests. Unfortunately, this isn't true for most. There's a crucial word you need to know: fiduciary. Fiduciary versus suitability standard. A fiduciary advisor has a legal and regulatory duty to put your interests ahead of their own. They cannot be paid to steer you into overpriced products you don't need. Think of it like a saleswoman who must find you the best dress for your budget and needs. The suitability standard, used by the majority of advisors, simply means the advice given is basically okay. These advisors can recommend products that benefit their bottom line, e.g. higher commissions, even if there's a better, cheaper option for you, and they don't have to disclose this conflict. The academic study that sent actors with perfect portfolios to brokerages found that over and over, clients were steered into high-fee investments, and women often received worse advice without even being asked about their financial profile. Most clients had no clue they were given suboptimal advice, meaningless designations. Be wary of the hundreds of fancy titles advisors use, e.g., Chartered College Planning Specialist, Senior Expert. Many are designed to sound important, but mean precisely nothing, and disguise the fact that these individuals are often simply salespeople or brokers. No free lunches. If you're invited to a complimentary financial seminar or dinner, understand that you are the product. These events are almost always sales pitches for high-cost, often subpar products, preying on fears about retirement and taxes. As Harold says, if you sit down for cards and you don't know who the sucker is, you do. Banks and brokerages are not your friends. While friendly, frontline staff at major banks and brokerages are often under intense pressure to meet sales quotas for financial products that frequently cost more and underperform simple index funds. They're not obligated to tell you that stock picking doesn't work or that their products are subpar. Melissa, who wisely invested her initial funds in low-cost index funds, later discovered that an inheritance managed by her mum's friendly financial advisor experienced significantly slower growth due to fees more than double her original portfolio. Pay for good advice. If you want unconflicting financial advice, you almost certainly have to pay for it directly. Many people are unaware how advisors are compensated, leading to hidden costs like loads, front-end fees, back-end loads, penalty for early withdrawal, or trailing fees, ongoing commissions. These backdoor payments and hidden fees cost Americans billions annually. Seek fee-only advisors. This is crucial. Avoid fee-based advisors, who can charge a flat rate and still earn commissions. A fee-only advisor is paid by you and only you, eliminating conflicts of interest. Payment can be a percentage of assets under management, a flat fee for specific services, or an hourly rate. How to find a fiduciary. Look for credentials like Certified Financial Planner, CFP, or Registered Investment Advisor, RIA. Our most important step is to ask directly and specifically. Do you work to the fiduciary standard at all times? Get it in writing, perhaps by asking them to sign an oath. Even with a fiduciary, you still need to do your due diligence by checking their disciplinary records with FINRA, the CFP board, or state regulators. Robo-advisors can offer lower-cost advice, but you must still verify if they are fiduciaries. Key takeaways for rule number 6. Most financial advisors are not legally obligated to act in your best interest. The crucial term to know is fiduciary, which means an advisor is legally bound to put your interests first and avoid conflicts. Always ask specifically, do you work to the fiduciary standard at all times? Seek out fee-only advisors who are paid directly by you, percentage of assets, flat fee, or hourly rate, as this eliminates commission-based conflicts. Be highly skeptical of free financial seminars or advice from banks and brokerages, as they are often sales pitches for high-fee products. Even with a fiduciary, perform due diligence by checking their background and disciplinary records with regulatory bodies. Rule number 7. Buy a home when you are financially ready. When Harold and Veronica bought their first home, they were eager but not entirely ready. Harold borrowed heavily, even from his sister, and bypassed candid advice from a loan officer who bluntly told him he wasn't a good customer. More than a decade later, with his home worth significantly less than he paid, Harold realized that loan officer offered rare candor, not to mention excellent advice. For much of American history, homeownership wasn't the norm. Mortgages were limited and required huge down payments. It was only after the Great Depression and World War II, with government subsidized, low down payment mortgages, that homeownership became a widespread dream. This led many to mistakenly believe their homes were can't-miss investments. Home prices don't always go up. Despite popular belief, home prices can and do fall. Your home is often your largest financial asset, but it's also a highly leveraged and risky investment. A 10% drop in market value can wipe out all your home equity if you only have a 10% down payment. Expensive automatic savings plan. While homeownership can act as an automatic savings plan by forcing you to pay down a mortgage, it comes with a high expense ratio. Beyond the principal, you pay significant interest in the early years, plus property taxes that almost always increase, and constant maintenance costs like leaky roofs and broken appliances. Renting has risks too, but can be better. Economists sometimes argue that renting and investing the difference can build more wealth in the long term. However, renting carries risks too, like dramatically rising rents that could price you out of a neighborhood. There are also practical benefits to owning, like control over your living environment. Know how much you can afford. Experts recommend spending no more than a third of your take-home pay on housing. Get mortgage pre-approval from a bank to set a realistic budget before house hunting. Decide on your essential needs, e.g., number of bedrooms versus luxuries. Be aware that real estate agents work on commission and may try to push you towards more expensive homes. Location is paramount. A less than perfect home in a desirable neighborhood often outperforms a gorgeous home in a lesser one. Homes are for the long run. Home ownership, like stock investing, is best as a long-term proposition. It generally takes at least 5 years to break even due to mortgage interest payments and transaction costs like real estate agent commissions, 3 to 6%. 20% down is best. While hard to save, a 20% down payment is ideal. It lowers your monthly mortgage payment, can secure a lower interest rate, and reduces the risk of being underwater, owing more than your home is worth. If you put down less than 20%, you'll likely pay for private mortgage insurance, PMI, an annual cost of 0.5% to 1% of your home's value, which only protects the lender. 15-year versus 30-year fixed-rate loans. A 15-year loan offers lower interest rates and builds equity faster, but comes with significantly higher monthly payments. If your finances are tight, or you have other debts, a 30-year fixed-rate mortgage offers more flexibility. Plain vanilla fixed rate is best. Stick to traditional 15 or 30-year fixed payment mortgages. Avoid adjustable rate mortgages, ARMs, or interest-only loans, which start with lower rates but can increase unpredictably, adding complexity and uncertainty to your life. Emergency savings first. Before buying a home, your emergency fund must be fully funded. Harold and Helaine have countless stories of unexpected home repairs, shown furnaces, basement leaks, raccoons in the attic. Your emergency fund is crucial for covering these unexpected expected expenses without derailing your mortgage payments. Get debt under control. Banks will assess your debt-to-income ratio. If your debt, credit cards, student loans, car loans, combined with your mortgage exceeds 43% of your income, you'll struggle to get a conventional mortgage and might face higher interest rates. Shop for a mortgage. Don't just go with the first offer. Almost half of us don't shop around for mortgages, costing us thousands over the life of the loan. Compare options from multiple banks or mortgage brokers and use online comparison sites. Flip pancakes, not houses. Your home is your home, not a speculative investment. Leave real estate speculation to professionals. It's a job requiring specific expertise and financial reserves that most individuals lack. Key takeaways for rule number 7. Buy a home when you are financially ready, not as a guaranteed investment. Ensure your emergency fund is fully funded and high-interest debt is under control before you consider buying a home. Aim for a 20% down payment to avoid private mortgage insurance, PMI, and secure better interest rates. Choose a plain van, a fixed-rate mortgage, 15 or 30 years, for stability and predictability. Shop around for your mortgage to compare rates and fees from multiple lenders. Prioritize location and practical needs over superficial features. Remember that homeownership is a long-term commitment, typically requiring at least 5 years to break even. Rule number 8. Insurance. Make sure you're protected. When Bob, a corporate executive, suddenly collapsed at work, his family faced a dire financial crisis as he could no longer work and his wife's income couldn't replace his. Mercifully, Bob had disability insurance, which, while not replacing his entire income, kept his family from falling into a financial abyss and gave them breathing room. This illustrates a powerful truth. Insurance, though depressing to think about, is absolutely essential for protecting your finances. Going without proper insurance can destroy all the hard work you've put into building your financial foundation. Life insurance. This pays off if the covered person dies, replacing wages or the value of services provided by a stay-at-home parent. The best and least costly type is term insurance, which offers protection for a set period, e.g. 30 years, for an annual fee. Opt for level term, where the price remains the same each year. Avoid whole life or universal life, cash value policies. These combine insurance with an investment component, but they come with ridiculous high fees, high commissions for salespeople, and limited, high-cost investment options. They are often pitched with misleading claims about covering estate taxes, which only apply to very few, wealthy estates, or outsmarting college financial aid, which private colleges are onto. Don't rely solely on employer-provided life insurance, as it's often insufficient and may not be portable. Shop around for policies from different agents and comparison shopping sites. The younger and healthier you are, the cheaper it will be. Disability insurance. 1 in 4 20-year-olds will become disabled before retirement age. If your employer offers disability insurance, sign up immediately. Social Security Disability Insurance, SSDI. Payments are low and hard to get, with a majority of applications denied. Property insurance, homeowners, and so on. The goal is to protect your net worth, not cover every minor repair. For homeowners insurance, be wary of companies that lowball or deny claims during catastrophes. Understand exactly what your policy covers, e.g., differentiate between flood and wind damage, and get answers in writing. Choose high-deductible options for property and auto insurance. This significantly lowers your annual premiums because you'll use your emergency fund for smaller issues, saving insurance for truly catastrophic events. Raising an auto deductible from $500 to $2,000 can save 15%. For auto insurance, liability coverage is the most important part. Do not sign up for minimum coverage, as inadequate liability can ruin you financially if you're in a serious accident. Aim for liability at least twice your net worth, and consider umbrella insurance for higher net worth. Collision coverage is less critical for older cars. Renter's insurance is inexpensive and crucial. It protects your possessions. Choose replacement cost over actual cash value. and provides liability coverage if someone is injured on your rented property. Health insurance. Since the Affordable Care Act, ACA, everyone can get health insurance regardless of pre-existing conditions. Never go without health insurance, as medical debt is a leading cause of bankruptcy, even for those who had insurance. Comparison shop every year. Investigate options on sites like healthcare.gov and understand different plan types: bronze, silver, gold, platinum. Crucially, double-check that your preferred doctors and hospitals are in Dash network. Maintain a strong emergency fund to cover high deductibles and copay, which have soared even for employer-provided plans. Don't think you can go bare and buy insurance only when you get sick. Marketplace coverage is only available during specific enrollment periods or after qualifying life events. Annuities. Be cautious. While some, like immediate annuities, fixed monthly payments for life, or longevity annuities, payments start later, ensuring you don't outlive savings, can provide peace of mind. Ensure they are fixed annuities from low-cost providers like Vanguard or TIAA Refugees. Avoid variable annuities and equity-indexed annuities, which have very high fees and capped gains due to large commissions. Unnecessary insurance. Say no to extended warranties on appliances, credit card payment protection, identity theft insurance, and life insurance on newborn babies. Sorry, Gerber. The only exception the authors make: cell phone insurance for teenagers. Protect yourself against bad protectors. Buy insurance from reputable companies that score well in consumer guides. If your insurer denies or mishandles a claim, contact your state insurance commission or attorney general. Key takeaways for rule number 8. Insurance is a vital protection for your net worth against major financial disasters like illness, disability, or property loss. For life insurance, opt for term life policies over costly, high-commission cash value, whole, or universal policies. Prioritize disability insurance if available through your employer, as SSDI is often insufficient. Choose high deductibles for homeowners and auto insurance to lower premiums, using your emergency fund for smaller repairs. Ensure you have adequate liability coverage for auto and home, at least twice your net worth, and consider umbrella insurance. Never go without health insurance. It's your strongest defense against medical debt and bankruptcy. Be highly skeptical of complex, high-fee annuities and other unnecessary insurance products. Wheel number 9. Do what you can to support the social safety net. Harold's personal financial success is largely due to his stable job and good financial decisions. However, his family's ability to cope with his brother-in-law Vincent's care and his wife's illness would have been impossible without the support of the American taxpayer, through programs like Medicare, Medicaid, and Social Security. Similarly, Helaine's husband's grandmother's cancer in the 1960s left her family broke, a scenario that would likely be different today thanks to Medicare. This underscores a powerful, often overlooked point. While personal financial planning is crucial, it can't protect us from everything. Unexpected bad financial luck, like severe illness or job loss, can derail even the most disciplined individual. Government as last resort insurance. The truth is, our financial lives would be far more precarious without government social programs. They are the insurance backer of last resort. Social Security, for instance, is the largest pension and protection most Americans will ever see, keeping almost half of elderly Americans out of poverty. Acknowledging collective support. Surveys show that 96% of Americans have, at some point, relied on government financial supports to get by or improve their situation. Yet, over 40% of people who have received Social Security, unemployment insurance, or student loans don't even realize they've used a government social program. Speak up and advocate. It's vital to support programs like Social Security and Medicare. When you hear them disparaged, speak up and remind others that these are government programs that benefit millions. Be honest about not just what you pay in taxes, but what you receive in return. By acting together, we protect one another against financial and health risks that would crush any one of us alone. Our individual financial planning has a better chance of success when supported by a robust social safety net. Key takeaways for Rule 9. Personal financial planning is not enough to protect against all life's challenges. Unexpected events can derail even the most disciplined. The government's social safety net, including programs like Social Security, Medicare, and unemployment insurance, acts as an essential insurance backer of last resort. These programs provide a crucial collective defense against financial and health risks that individuals cannot manage alone. Recognize and acknowledge your own reliance on government programs, and advocate for their continued support for the benefit of all citizens. You don't need to be a financial whiz to understand and act on these principles. This isn't rocket science. If it were, it wouldn't all fit so neatly on one index card. The power lies in simplicity and common sense. By following these rules, you'll gain the confidence to make your own financial decisions, understand basic financial truths like the superiority of low-fee index funds, and be armed with timeless guidelines for any financial issue. You'll spend less time worrying about money and more time enjoying your life. Take control of your financial life today. If you found this helpful, please like this audio, subscribe to our channel for more practical financial insights, and leave a comment below sharing your own financial takeaways or questions. We'd love to hear from you.